Hello and welcome to AI Market News by LM. Before we jump into the market action at the end of Q3 and what's shaping up for October, we need to start with an important disclaimer.
Right. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. And just to be clear, this video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, great. So let's get into it. Our aim today really is to cut through the noise and give everyone a clear picture of where things stand now that the quarter's closed. We're going to focus on this weird situation with the U.S. shutdown risk maybe actually helping risk assets.
Paradoxical, yeah.
And some huge corporate deals, plus this growing split between what central banks are doing globally. It feels like a really pivotal moment.
It absolutely is. I mean, you look at the hesitation in Tokyo, the inflation numbers ticking up in Europe, that political back and forth in Washington, it all connects, It feeds into treasury yields, the dollar, and ultimately market direction.
Let's kick off with the U.S. then. The quarter ended, well, a bit volatile, but the main indices actually finished slightly up. NASDAQ led the way. Based on the prepared resources, the Dow, S&P 500, NASDAQ, small gains at the Q3 close. Futures are pointing a bit lower now, though. But like you said, the headline number isn't the real story here. It's this looming U.S. government shutdown.
Exactly, and that's the shutdown paradox we're seeing play out. The deadline is midnight, September 30th, Washington time. Normally you'd think, okay, political gridlock, that's bad news, bearish. But look at how traders are reacting right now. They seem to be taking it as a net positive for U.S. stocks and risk assets.
Which feels totally backwards, doesn't it? How can Washington failing be good for the market?
Well, it boils down to guessing what the Fed will do next. A shutdown means basically two things in the short term. One, maybe less government spending, which could cool inflation a bit. Two, and this is the big one for the Fed, it delays key economic data, like the non-farm payrolls report everyone watches.
Ah, okay. So if the jobs data gets delayed.
Traders assume the worst. They figure, well, maybe the jobs market is weakening faster than the official numbers show.
And if the market thinks the labor market is weakening, it bets the Fed will have to cut interest rates sooner to prop up employment.
Precisely. That expectation immediately pushes Treasury yields down. We saw the 10-year yield dip to 4.141%. This demand for safe treasuries lowers yields, which kind of undermines the U.S. dollar, but it helps boost riskier things like stocks. It's a very tactical short-term play based on expecting the Fed to blink.
Speaking of jobs, we did get some data just before this shutdown deadline, and it looked, well, messy. What did those September 30th numbers show?
Yeah, they were pretty mixed, which just highlights the Fed's problem. The Chicago PMI, that regional manufacturing gauge, actually came in better than expected, 43.4, so maybe some resilience there regionally. But the consumer picture looks weaker. Consumer confidence for September missed the forecast, came in at 96.0.
And JOLTS? The job openings number? Still high?
Still sticky, yeah. JOLTS says for August was slightly above what was expected, 7.190 million openings. So you've got this tight job market, but consumers are getting nervous. All while the economy seems okay, right up until a shutdown potentially hides the data.
Which probably explains the cautious tone from Fed Vice Chair Jefferson recently.
Yeah, Jefferson was really walking a fine line. He specifically mentioned higher risks on both sides of their mandate. Inflation could go higher, employment could go lower. He said he expects unemployment to rise a bit this year, then dip next year, and inflation getting back to 2%, but maybe only within a few years. And remember, the FOMC already cut rates this month and expects 2 more this year. That shows they are worried about jobs, leaning a bit dovish maybe.
Okay, before we move off the U.S., what's the general market mood? The CNN Fear and Greed Index tracks things like volatility. What's the VIX doing?
Right, the Fear and Greed Index gives us a sense of emotion. The VIX, the Volatility Index, is around 16.57, up a bit, about 2.8%. So a VIX in the mid-teens. It tells us there's definitely some concern, maybe about the shutdown drama, but it's not panic stations. Investors are cautious, positioning defensively perhaps, but not running scared. The volatility is there, but it seems contained, reflecting that weird shutdown optimism we talked about.
Okay, let's shift focus overseas. The big story seems to be this divergence between central banks, Japan potentially tightening, Europe holding steady.
Absolutely. Let's look at USD JPY first. It's trading around 147.99. This pair is getting a lot of attention because the market is really starting to believe the Bank of Japan, the BOJ, might finally hike rates.
Yeah, the odds seem to have jumped quite a bit, like 62% chance priced in for a BOJ hike in October. What came out of their last meeting summary?
Well, it showed a real split internally. That's usually a sign something might be changing. You had some members pushing hard, saying they should adjust rates at regular intervals if the inflation outlook stays positive.
Yeah.
They want to normalize policy faster.
But others were saying, hold on, not so fast.
Exactly. Others urged caution, saying basically, let's not surprise the markets right now. Let's wait for more solid data to prove inflation is really sticking around because of domestic factors, not just global prices. But even with that debate, they are taking a small step. They decided to buy fewer long-term Japanese government bonds in the next quarter. That suggests conditions are maybe improving a bit.
Okay, turning to Europe. Your USD is up slightly, 1.1740. The inflation picture there is almost the opposite of Japan's, right? It's picking up, but still low overall.
That's the puzzle for the European Central Bank, the ECB. The September inflation numbers, the HICP, they showed acceleration in big countries like France and Italy. France hit 1.1% year over year. Italy hit 1.8%.
But even with that rise, they're still quite a way below the ECB's 2% target.
They are. And that's why the ECB sounds patient. Vice President Guindos basically said the current 2% policy rate is appropriate. They seem happy to wait and see for now. We'll get the overall Eurozone inflation number on October 1st, expected at around 2.2%, so that'll be key. But yeah, the big picture is divergence. BOJ might tighten, Fed looking to cut, ECB holding steady.
Right. Now, shifting gears from macro to micro, or maybe not so micro. Now, this massive electronic arts LBO, $55 billion for EA, that's huge.
It's a landmark deal, definitely. Shows a huge global appetite for big assets. And the price, $210 a share in cash. That's a hefty 25% premium.
Yeah.
The buyers are interesting too. Silver Lake, Jared Kushner's firm Affinity Partners, and notably Saudi Arabia's public investment fund, the PIF. This really cements PIF's move, doesn't it? Shifting focus from just oil into areas like gaming.
The sheer size is staggering, but the financing, that seems like the real inside story here. JP Morgan providing a massive chunk of the debt.
Oh, absolutely. This was a huge win for the big traditional banks against the private credit funds that have been growing so fast. For smaller deals, private credit has been competitive. But for something this enormous, $55 billion, you need the balance sheet muscle of a giant like JP Morgan. JPM put up $20 billion in debt financing themselves. That's the largest single bank commitment ever for an LBO. It shows the big banks still dominate the mega deals.
Quite a contrast then to what's happening in traditional energy. While tech gets massive buyouts, oil companies are cutting back.
Yeah, we're seeing ExxonMobil planning about 2,000 job cuts globally. That's maybe 3-4% of their workforce. It's part of a longer-term efficiency push, and it follows similar moves by Chevron, ConocoPhillips, BP. They're all adapting to a world of sort of persistently lower oil prices, focusing on leaner operations.
And quickly on commodities, gold had a strong run, but it's pulling back a bit.
Yeah, spot gold is easing off after that big rally in September where it jumped, over 10%. That initial move was driven by fear, the U.S. shutdown worries, geopolitical stuff. Gold loves uncertainty. But since full-blown panic hasn't really set in, we're seeing some profit-taking, consolidation around $3,800 an ounce.
And oil prices still under pressure.
Crude is still looking soft, yeah. WTI around $62.94. Brent, $66.57. The main reason seems to be the expectation that OPEC and its allies, OPEC Plus, will pump more oil starting in November. That's weighing on prices.
Okay, alongside the central bank shifts, we've also got trade policy adding friction, especially these new U.S. tariffs. What's the latest there?
Right, more uncertainty from trade. There's a new 10% tariff coming on softwood lumber and timber imports, effective October 14th. That'll hit construction. And also a 25% duty on upholstered wooden products.
And still threats against other imports too. Movies, furniture.
Yeah, the administration is still talking about potentially 100% tariffs on foreign movies and substantial tariffs on furniture. It just makes things tricky for retailers and others who rely on imports. There's a small bit of relief mentioned in the sources, tariffs on wood from the EU, and Japan won't go above 15%. But overall, it adds to the uncertainty.
Lastly, on the geopolitical front, there's the significant development regarding a potential Gaza peace plan.
Yes, high-stakes stuff. President Trump and Prime Minister Netanyahu apparently agreed on a 20-point plan to try and end the war. A key part is this humanitarian exchange, releasing the remaining 48 hostages, though sadly only 20 are thought to be alive, in return for 250 Palestinian prisoners serving life sentences. It's a major proposal, but the big question mark is Hamas.
Have they responded? Or what are they looking for?
The sources say Hamas hasn't accepted yet, They're likely going to demand more specifics, especially on when Israeli forces would actually withdraw from Gaza. So whether this diplomatic effort actually works really hangs on Hamas's response and everyone sticking to the plan.
Okay, so looking ahead now, we're heading into October. What key dates or data points should we be watching based on the investing.com economic calendar?
Well, first up is that Eurozone inflation number on October 1st. The forecast is 2.2%. That'll be watched closely. But then, really, the main events circle back to the central banks. That's where the big move could come from. The next Fed meeting, the FOMC, is scheduled for October 28th and 29th. They'll revisit that whole inflation versus jobs tightrope.
And right after the Fed, it's the BOJ's turn, right? The one everyone's watching.
Exactly. The Bank of Japan meets October 30th. That's D-Day for those 62% odds of a rate hike. Those few days at the end of October look absolutely crucial for the market.
So, wrapping things up, the core tension really seems to be this strange mix of political risk in the U.S. having an unexpected effect, while central banks globally are just heading in different directions.
Yeah, you've got this weird dynamic where the U.S. shutdown risk is, kind of ironically, helping risk assets by pushing yields down and pressuring the dollar. The market's almost cheering the dysfunction, thinking it means easier Fed policy.
While at the same time, the BOJ might finally be about to tighten after decades, the ECB is holding firm well below its target, and the Fed's signaling cuts even with sticky job numbers. It's quite the divergence.
Resolving that central bank divergence is probably the main story for the next few months. But maybe one last thought to leave folks with. Thinking about that massive AA deal, if the biggest LBO ever only happened because one single bank could write a $20 billion check,
Well,
what does that tell us about concentration risk in finance? Especially as more big corporate deals might be coming down the pipe. Something to chew on.
definitely food for thought. Okay, that's our deep dive for today.
Thanks for watching. Don't forget to like and subscribe.